You work hard for your money. Every day you put in the hours, the effort, and the dedication to earn your paycheck. It's time to make your money work hard for you. Instead of just sitting in a savings account, your money can grow and multiply. That's what investing is all about. Putting your money to work. By investing, you are giving your money the opportunity to grow. When you invest, you're buying something today with the hope it will be worth more tomorrow. This could be stocks, bonds, real estate, or other assets. This is how you build wealth over time. By making smart investment choices, you can see your money grow exponentially. Investing might seem scary, especially if you're new to it. The world of finance can be intimidating with its jargon and complex concepts. But don't worry, it's like anything else. The more you learn, the easier it gets. With the right knowledge and guidance, anyone can become a successful investor. This guide will walk you through the basics of investing, helping you make smart choices for your financial future. We'll cover everything from understanding different types of investments to creating a diversified portfolio. Remember, the best time to start investing was yesterday. The second best time, today. The sooner you start, the more time your money has to grow. Investing allows your money to grow over time through the power of compounding. Compounding is like magic. It's the process where your investment earnings generate their own earnings. It's the snowball effect of earning money on your initial investment and then earning even more money on those earnings. Over time, this can lead to significant growth. The longer you invest, the more powerful compounding becomes, helping you build significant wealth over the long term. Patience and consistency are key. Whether you're saving for retirement, planning for a comfortable and secure future, a down payment on a house, or your children's education, investing can provide the financial foundation you need. Investing can help you reach your financial goals faster. It can turn your dreams into reality by providing the necessary funds when you need them. It's the key to growing your wealth and securing your financial future. Let's get started on this exciting journey towards financial independence and prosperity. Investing is simply putting your money to work. It's about making your money grow over time, rather than letting it sit idle. By investing, you are essentially making a choice to take control of your financial future. You're buying a piece of a company, which means you own a small part of that business. When the company does well, your investment grows. A piece of the government's debt, which is often considered a safer investment. Government bonds can provide steady returns with lower risk, or a piece of property. Real estate can be a tangible and lucrative investment, offering both rental income and potential appreciation in value. The goal is for your investment to grow in value over time. This growth can come from appreciation, dividends, or interest, depending on the type of investment. There are many different ways to invest, each with its own set of risks and rewards. Stocks, bonds, mutual funds, ETFs, real estate, and more. The options are vast. And the right approach for you will depend on your individual financial goals, risk tolerance, and time horizon. It's important to align your investments with your personal objectives. Some people are comfortable with higher risk investments that have the potential for higher returns, such as stocks or cryptocurrencies, while others prefer to play it safe with lower risk, lower return investments like bonds or savings accounts. These options provide more stability and less volatility. It's crucial to understand your risk tolerance before making any investment decisions. Knowing how much risk you can handle will help you choose the right investments. Risk tolerance refers to your ability to stomach potential losses in your investments. It's about understanding how much fluctuation you can endure without panicking. If you're someone who panics when the market dips, you might have a lower risk tolerance. Market downturns can be stressful, but they are a normal part of investing. You might have a lower risk tolerance and should consider more conservative investment options. These options may not offer the highest returns, but they provide peace of mind. On the other hand, if you're comfortable riding out market fluctuations and understand that investing is a long-term game, you might have a higher risk tolerance. You might have a higher risk tolerance and be open to exploring investments with potentially higher returns. These investments can offer significant growth over time. Remember, there's no right or wrong answer when it comes to risk tolerance. It's all about finding what's comfortable for you. Your investment strategy should reflect your personal comfort level. Investing is not just for the wealthy, it's for everyone. Regardless of your income level, you can start investing and build wealth over time. You don't need a lot of money to get started. Many platforms allow you to begin investing with small amounts, making it accessible to everyone. With a little planning and discipline, anyone can become a successful investor. It's about making informed decisions, staying patient, and being consistent with your investment strategy. Educate yourself about different investment options and strategies. The more you know, the better equipped you'll be to make smart investment choices. Consider seeking advice from a financial advisor if you're unsure where to start. They can help you create a personalized investment plan that aligns with your goals. Remember, investing is a journey. Celebrate your milestones along the way and stay focused on your long-term goals. With time and perseverance, you can achieve financial success. Stocks represent ownership in a company. When you buy a stock, you're buying a tiny piece of that company, making you a shareholder. As a shareholder, you have the potential to profit from the company's success. There are two main ways to make money from stocks: dividends and capital appreciation. Dividends are payments made by a company to its shareholders, typically from its profits. Capital appreciation occurs when the price of a stock increases, allowing you to sell it for a profit. However, it's important to remember that stock prices can go down as well as up. The stock market is influenced by a wide range of factors, including economic conditions, interest rates, and company performance. This inherent volatility is why investing in stocks carries a certain level of risk. Despite the risks, stocks have historically outperformed other asset classes over the long term. If you're looking for the potential for high returns and have a longer time horizon, investing in stocks might be a good option for you. Just remember to do your research and invest in companies you believe in and that have a solid track record. Section 4: Bonds, your steady income stream. Bonds are a fundamental component of many investment portfolios, providing a reliable source of income and stability. Bonds are like loans you make to governments or corporations. When you purchase a bond, you are essentially acting as a lender, providing the issuer with the capital they need for various projects or operational needs. When you buy a bond, you're lending money to the issuer for a fixed period of time at a fixed interest rate. This fixed interest rate is often referred to as the coupon rate, and it determines the periodic interest payments you will receive. The issuer promises to pay you back the principal, which is the amount you lent, when the bond matures, along with regular interest payments. These interest payments are typically made semi-annually, providing a predictable income stream. Bonds are generally considered less risky than stocks. This is because the bond market tends to be more stable, with less dramatic price fluctuations compared to the stock market. This is because bondholders are creditors, meaning they have a higher claim on the issuer's assets than stockholders in the event of bankruptcy. In other words, if the issuer faces financial difficulties, bondholders are more likely to recover their investment than stockholders. However, bonds still carry some level of risk, including interest rate risk and credit risk. It's important to understand these risks to make informed investment decisions. Interest rate risk refers to the possibility that interest rates will rise, making your bond less valuable. This happens because new bonds issued at higher interest rates become more attractive to investors, reducing the demand for existing bonds with lower rates. For example, if you buy a bond with a 5% interest rate and interest rates later rise to 6%, your bond will be worth less because investors can now buy new bonds with a higher yield. This inverse relationship between interest rates and bond prices is a key concept for bond investors to understand. Credit risk refers to the possibility that the bond issuer will default on its debt and be unable to repay its bondholders. This risk is higher for corporate bonds compared to government bonds, as corporations are more likely to face financial difficulties. Governments are generally considered less risky than corporations when it comes to credit risk, but even government bonds carry some level of risk. Factors such as political instability or economic downturns can impact a government's ability to meet its debt obligations. Overall, bonds can be a good addition to any diversified investment portfolio. Diversification helps spread risk across different asset classes, and bonds can provide a counterbalance to the volatility of stocks. They offer a steady stream of income and are generally less volatile than stocks. This makes them particularly attractive for conservative investors, or those nearing retirement who prioritize income stability over high returns. However, it's important to understand the risks involved, and to choose bonds that align with your investment goals and risk tolerance. Different types of bonds, such as municipal bonds, corporate bonds, and treasury bonds, each come with their own risk and return profiles. By carefully selecting bonds that match your financial objectives, you can build a robust and resilient investment portfolio. Section 5: Mutual Funds and ETFs, Investing Made Easy.